Okay, so in this lesson we are going to talk about reverse mortgages 101, also known as a HECM or a home equity conversion mortgage. So now that we know a little bit about these mortgages and how they might work and some of the misconceptions, let's see how they fit into our personal economic model. In other words, our tanks. How do they fit into our overall picture, and how could they potentially help us out in retirement to increase our income and give us access to some tax-free income? So here we have these three main tanks that we're going to be focusing on. We have our house, which has some equity in it. In this case, it looks like it's paid off. There's no loan against it. So it looks like we could borrow, a line of credit using a reverse mortgage. So let's zoom in on these three tanks and look a little bit closer. So first of all, you have to have at least 50% equity in your home. That's the first thing. And you can access a minimum of 50% of the equity. In fact, if you're older, in a lot of cases, depending on the loan, you can actually get more than 50% of the equity in your home. So you need to have, though, at least 50% equity in your home, and you'll be able to get that line of credit that we could use, and we call that a reverse mortgage. So first of all, this could be used to offset income shortfall, to increase your cash flow in retirement. So you could borrow against your line of credit, you could get an income stream that could pay you, and you could set up to where it will actually pay you an income the entire time you are living in that home, or for a certain period. There's a few ways to do it, which we'll talk about in a minute. Also, maybe you need to make some home improvements. You've had your home for 30 years, you finally paid off the house, but now you need a new roof or whatever the case may be. So you need to put some home improvements into it. Well, we could borrow against our line of credit and actually put it into the home. And in some cases, we could just use it for whatever we want. We can just spend it as we please. We can take that money, we can just borrow up to our line of credit limit, and we can spend it on whatever you want and increase your overall income, maybe for an unexpected expense or whatever the case may be. And you still own your home. One of the misconceptions that we talked about in the last module is that if you get a reverse mortgage, you no longer own your home. Not the case. You still own your home, and you just simply have an increasing mortgage, but with no required payments. So in a traditional forward mortgage, your loan actually goes down as you make principal and interest payments. In this particular case, the loan actually increases because of the interest and the payments that you're not making, basically. So for not making any payments, there's still some interest in everything that needs to go in to the cost of the loan, so your loan actually increases instead of decreases. Now, your home is still going to appreciate with or without a mortgage of any kind. So whether you have a forward mortgage or a reverse mortgage, the value of your home could still appreciate or depreciate for that matter. But if your home appreciates in value, here's what's really cool about the reverse mortgage line of credit is that it's going to increase as well. You don't even have to qualify for it. It just increases based on the value of your house. So if markets go really well, like in 2006 and 2007, right before the crash, your house could go up in value, your line of credit could go up, and you could tap in to that increased line of credit, So now what happens if you want to actually sell your house? Well, you or your heirs, if they choose to sell the house, could just pay off whatever those liens were, and then whatever that equity was could be yours to keep. So you're not tied to this. It's not like if you get a reverse mortgage, you can never sell your house, or if you die, your kids aren't going to get anything. Whatever the equity was in your house, above and beyond what you owed on that reverse mortgage, is going to go to your heirs. Now, what happens if the value of your house goes up really high, like in 2006 and 2007, and then in 2008, it crashes and it's worth less than what you've borrowed in this reverse mortgage? What if you actually owe more on your reverse mortgage than on your house? Well, guess what? You nor your heirs are responsible for that. I know a lot of people who in 2007 and 2008 wanted to upgrade because maybe they wanted a bigger house, maybe their family was growing, but they couldn't sell their house because they bought it in the peak and now they actually owe more than what the house is worth. So they had to stay in the house for another 5 or 10 years until the house was worth more than what they owed. But in a reverse mortgage situation, if the house was worth this, and then all of a sudden the house is worth this, and you die, your heirs are not responsible for the difference. And if you're still alive and your situation looks like this, you're also not responsible for that. Okay, so that's really cool. Okay, so what if you already have a primary mortgage, a forward mortgage, a traditional mortgage, and you want to use this reverse mortgage because you've got all this equity in your home. Remember, you have to have at least 50% equity in your home. So in this case, we've got way more than 50% equity in the home, but we still have this little mortgage left on it. As long as you're 62 years old, currently, it might change, so double check all these numbers. But if you're over 62, you would qualify for that reverse mortgage if you have at least 50% equity in your home. So what they could do is they could actually pay off that traditional mortgage with a reverse mortgage, and now you've got a reverse mortgage balance, all right? But you have access to all of that equity because now you've got this line of credit, all right? 50% at least of the equity in your home, and so now you can tap into that and you don't have to make a payment. So no more monthly payments because your loan is just going to increase. It's not a decreasing loan, it's an increasing loan because of those payments and because of the interest on that loan, right? But you could tap in to the remaining amount of equity for whatever you wanted, for increased cash flow, to pay for some unexpected expense, home improvements, whatever the case may be. Now, what about 3 tax-free options to access the money? This is a beautiful thing because if you take out the emotions of this being your home and you think about this as being one of your biggest assets and how you can access this asset during retirement, you can do it in 3 ways, all tax-free because it's a loan. Okay, first of all, you could get a line of credit. So that means that even if you don't need it, so let's say you go into retirement and your house is paid off and you still want to get a line of credit just in case. Now remember, it's a line of credit. You're not using it, right? So there's no charge, there's no interest that's being charged, but it's a line of credit in case of an emergency. What if during your retirement years, you need to tap into that and you don't want to jump through the hoops of getting a traditional home equity line of credit or a first or second mortgage, or sometimes people do a cash out refinance. I know right now, because interest rates are low and everyone's refinancing, it's taking up to 3 months or longer to get a traditional mortgage, like a first mortgage or a second mortgage or whatever the case may be, because underwriting is taking so long. So what if you would just want a line of credit that you could tap into in case you needed it? Or maybe you want a monthly income stream. Now this is a little bit different than an annuity that gives you a guaranteed lifetime income stream. This is guaranteed for the life that you're living in the home until you sell the home or until you maybe move into an assisted living center. But as long as you're living in the home and you have this reverse mortgage in place, the lending institution will give you a monthly income stream. Now this could be, calculated until age 100. It basically means that it'll just pay you for the rest of your life as long as you're living in the home. Or you could specify a certain period of time. So maybe you just want an income for 10 years. Well, of course, that would determine what the actual income amount is each month. But you could get some sort of an income stream while you're living in the home to put towards your monthly expenses. Or you could actually get a lump sum, meaning you could borrow up to the full amount, which depends on your age and depends on the loan. You could take that lump sum and invest it wherever you wanted. For example, maybe you could put that into a traditional annuity, an annuity with an insurance company that does give you a guaranteed lifetime income for the rest of your life. And depending on the annuity, it might even give you an increased income during your lifetime instead of just a flat income like the reverse mortgage income. That's typically a flat income. This could give you an increased income depending on the annuity that you get. So lots of things to consider, but the most important thing is that all three of these are tax-free because it's a loan. So I really want you to think about this because of what we talked about in the tax module and in the qualified plan module. This is so powerful because remember, in a qualified plan, your income is increasing, and by the time you retire, you're going to try to retire at the same level of income, right? Well, that means you might be in the highest income tax bracket. But what if you could retire on the same lifestyle that you had while you were working, but what if some of that money was loans? Now, we're going to talk about another way that you can retire on loans in future modules and lessons, but if you could borrow money in retirement to live on, a reverse mortgage being one of the two ways that you can commonly do this, then that loan income that is tax-free does not count against your income, which improves your Social Security benefits because less of your Social Security might be taxed and less of your qualified plan money, like your IRAs, your 401ks, less of that might be taxed if some of your income in retirement is through loans tax-free. So just some things to think about. Remember, we're all about thinking outside the box, and we're all about thinking about how we can use these assets to improve our overall situation, provide more stability, provide more cash flow, and give us those lifetime income streams that we're looking for, and just basically give us that income and that financial freedom that we all want. So use your home wisely. Think about it more as an asset. And don't worry about the emotional side of things as much if you can. I know it's hard. I know in this particular case, we've talked in this module about mortgages, and we've talked about how stressful it can be and how you want your house to be paid off. And I understand, but remember, there are more than one ways to pay off your house. You could still have your house paid off and still have a mortgage. Because remember, as long as you've got more money in your account than what you owe, so you have more assets than liabilities, then you're not in debt, right? So, and if your assets are earning more interest than your liabilities are costing you, then you're getting further and further ahead. So keep in mind, it's all about thinking outside the box. If you have any questions about a reverse mortgage or if it's right for you, reach out to us. We can hook you up with somebody who offers reverse mortgages and that could help you understand the actual details of a reverse mortgage, because there's a lot of details to these, just like with a traditional mortgage, that you're going to want to understand. But hopefully this will give you an idea of how they work before you go and actually meet with somebody that sells reverse mortgages. So thanks for watching, and let's move on.